It is no surprise to anyone that high interest rates are starting to impact Canadian households. And because of that, I've decided to put together a video that goes over the 5 different things that my own clients are doing to manage cash flow and better prepare for their mortgage renewals that are coming up, and which are going to be a lot more expensive than what they're paying right now. In this video, there's going to be no silver bullet. There's going to be no hack, no tricks. It's just 5 different options. They all cost money. They all have their pros and cons. They will work for different people, for younger people, for older people. It's all going to be different. Depends how much equity you have in your home, where you are in your amortization. But the point is, at least you're going to be educated. You're going to know what's out there available to you in case you didn't know. Some of them are going to be more controversial than others, like reverse mortgages and private lending. I'm not going to spend too much time on that because if that's where you are right now, you should probably be looking at selling your house. But at least you're going to be educated. So without further ado, let's get into the video. My name is Vas, and I'm a real estate broker right here in the city of Toronto, where I help investors and families navigate our real estate. Let's provide some historical context here just so that we understand where we're at. Typically, in real estate, it takes about 12 to 18 months for people to feel the impact of high interest rates. And here we are right now, 18 months after the first rate hike, and people are feeling it, with mortgage renewals coming up in 2024 and a lot of mortgage renewals coming up in 2025 and 2026. Obviously, we don't know what those years hold, but we know that rates are likely going to be high going into 2024. And even if we do have rate cuts, let's say 12 months from now, are the cuts really going to be that drastic? Probably not. We're probably not going to all-time lows like we were in the past. So rates are going to be higher for a while longer. So with that, you have to make that consideration and the choice you're going to make in terms of how you're going to manage your cash flow based on the assumption that rates will be high So the 5 options that my clients are choosing and the ones I'm going to talk about in this video are: number 1, proving financial hardship to your lender. So this drops your monthly payment a little bit. It does have implications. We'll talk about those. Number 2, it's re-amortizing your entire mortgage. So let's say you had 5 or 10 years left on your mortgage. What does it look like going to 25 or 30 years, and what are the implications of that? Number 3, it's going to be downsizing. And this one's a little bit touchy because optically it doesn't look the same. The transaction costs are high. But for some people, downsizing into a cheaper property does make more sense. And I'll give you some personal examples of that. Number 4, it's actually 2 options, but I've lumped them in the same thing. It's converting your current mortgage into a HELOC or a reverse mortgage. These can work for some people. They're highly controversial, but again, worth looking into because for certain people, it may actually make sense. And the last one, the most highly controversial one, is going to a private lender if you cannot qualify with a regular bank to carry your current mortgage. My advice here as a general rule of thumb is if you're looking at private lending right now because you're tapped out, you're probably better off just selling your property. But again, I know this is a personal decision. You're going to figure out on your own. I'm just going to give you the information, the pros and cons. The most popular and the number 1 option I'm going to go through is claiming financial hardship with your lender. The reason this is popular is because a lot of people fear they may not qualify for their existing mortgage, so therefore they can't go and shop around for better rates with different lenders. So what they like to do is, if you claim financial hardship with your lender, assuming your lender is looking into things like this and is lenient, what they can do is they can extend the amortization of your loan. The shortest I've seen is 5 years, but I know some will extend past 5 years depending on your lender, depending on your profile, depending on if your mortgage is insured or uninsured. And effectively, that lowers your monthly payment once you renew your mortgage. And this is one way I've seen people try to manage their cash flow. And I'm going to run you through an example right now so that you can understand how the numbers work. So let's assume 5 years ago, you took on a $500,000 mortgage at 2% and your payment was $2,100. Over the term of this 5-year mortgage, you have paid off just over $80,000. So your ending principal balance is $418,000. And that is renewing today at 6.5% to 7%, depending on what rates you're getting. And then you have 20 years on your mortgage. Here's what happens next. At renewal, at let's say 6.5% with 20 years left, your mortgage goes up to $3,100 per month, which is a 46% increase. Now, just remember, mortgages are front loaded with interest. So anybody that's early on in their mortgage is going to see the biggest increase here. If you're later on in your mortgage, let's say you've had a mortgage for 20 years and you have 5 years left, where you're mostly paying principal towards the tail end of it, your increase is not going to be the same. So the people impacted the most from this are those with new mortgages that recently started. So let's assume your mortgage payment went up close to 50%. So you're thinking, what am I going to do? So your option with claiming financial hardship is saying to the bank, well, okay, I can do the 6.5%, but can we go back to 25 years instead of the 20 years? What does that do to my payment? Well, it reduces your payment by roughly $300, or it drops it about 10%. So your net increase is really 35% rather than the 46 that we have here. Obviously, this is not a significant game changer in terms of your net payments, but it is something, and this is something that I see people claiming or trying to do the most because it's the least intrusive and it's the least costly for you over the long run. Now let's look at option number 2, which is re-amortizing your entire mortgage. I'm really not a big fan of this, but if you have to manage cash and you understand that this is going to be a short-term thing, I suppose it's something that you should consider. So this is typically something that's going to be beneficial for people that have been further along in their mortgage, that have less years left in their mortgage, that have significantly more equity in their homes. So these are the people that are going to see the biggest bang for buck here, and here's why. I'll walk you through an example right now. Let's say 10 years ago you took on a mortgage of $250,000. This was the remaining principal left that you had to pay off on your mortgage. You have 10 years left on it. It was a 2%. Your payment was $2,300. Now, most of your money is going to be going into principal at this tail end of your mortgage. So after 5 years, you've paid off roughly $70,000. You have $131,000 that's coming up for renewal right now at these high rates. So what happens? Like I had mentioned earlier, because mortgages are interest front-loaded and principal back-loaded, meaning you're paying mostly interest in the beginning of the mortgage and mostly principal at the tail end. This interest rate increase from 2% to 5% with a 5-year amortization left only yielded an 11% increase to the total payment for these people. Now, let's assume these people are elderly, maybe they're on fixed income, whatever the case may be. What they can do, assuming they can qualify, is they can re-amortize the 5 years and make it into a 15-year mortgage. So instead of 5, they go to 15, and they can effectively drop their mortgage payment from $2,500 to $1,100. Now, once again, I have to remind everybody that if you don't have to do this, don't do it, because again, you're just tacking on more and more interest and extending the mortgage repayment of your home. It is also worth noting that you can actually go way further than 15 years. You can probably qualify for a 30-year mortgage on the small amount that you have left. Again, I don't recommend it because you're never going to pay off this house at this rate, but it is an option that is available to you. Option number 3, and this one hurts a lot, but it's selling your house and downsizing, moving into something cheaper, or just coming out of the real estate market altogether and possibly renting. This depends on where you are in your life, what kind of earning potential you have in the future, a number of other factors that I can't advise you on, but just giving you the options with some examples of what people that I've worked with in the past have done and why. The 2 biggest cons right out of the gate for selling your home. Number 1, the optics. How does this look to everybody else, friends, family? Nobody wants to be downsizing if they don't have to, especially if they love where they live. So that's number 1. And number 2, the transaction cost. To sell a house and then buy a cheaper house, and the land transfer tax and the realtor commissions, all this stuff, it is very expensive. You still have to consider this, because even with those costs, it might make the most sense for you. It really will depend on your personal situation. Now let's get into some examples. So earlier this year, I had a couple in their 70s. They were on fixed income. They had a $1.5 million house, and they had a $700,000 reverse mortgage on the home. Now, the unfortunate part is that this reverse mortgage was variable. So effectively, as interest rates went up, it started chewing away more and more of the equity in their home. Now, they weren't making any payments, they had no payments to make, but it was just eating away through their equity. And at the pace that it was eating away their equity, they would effectively be forced to sell this home once the price of the home and the amount of equity left in the home started getting very close. So this way, they were at $700,000 of debt through the reverse mortgage and about a market value of $1.5 million. We ended up listing the house, selling it in the spring market when the market was good. They paid off the reverse mortgage, and then they went into a condo for, I think, $600,000, and they're mortgage-free, living life, and that's it. No more payments, no more stress, no more interest accruing and chipping away, chewing away their equity. Another example I can give you are people that are considering selling are those that are not quite ready for downsizing. Maybe they were 5 years out from downsizing, and they're at the top of their earning potential. Let's say you're 2 years from retiring from your current job, but with payments and rates where they are, and for them not to be going down in the near term. And even when they do go down, they're probably not going to go down to the all-time lows we've had. People like these are also considering selling because their quality of life is impacted, and because they're the tail end of their careers, they're not going to see an increase in their incomes. They're likely actually going to see a decrease in their incomes. So they're considering getting ahead of this, selling their homes now, downsizing to something cheaper, so they can maintain the lifestyle they want into retirement. And if this is something you are considering doing in the near term, one thing I will warn you about is, remember, when you're interviewing real estate agents about potentially listing your home, one, typical thing that happens is people that want the listing the most will likely give you the highest possible market value for your home. And you have to be very careful right now because it's very difficult to pinpoint a market value of a home because things are not selling. So even if I thought the market value of the house is $1 million and the last comparable sale was $1.1 million, that doesn't mean you're actually going to sell for $1 million. You might sell for 950 or 920 or potentially even lower, or you may not even sell because you might just sit on the market. So it's very important to not fall for who gives you the highest amount that they think your property is worth. Somebody has to walk you through the math, through the comparables, show you what the market is doing actively currently right now, to show you and convince you why they think they can get you the money that they're telling you they can get you. And then also, how are they going to bring traffic into your listing? I'm finding it very difficult, even with my abilities to do targeted ads, the way you have found this video through social media. It's still a challenge to bring people through listings. Some listings I've been able to successfully sell because of my ability to market. But then there have been some listings, especially condos, where no matter what you do, you're just not getting the traffic because everybody is sidelined and there's just very little interest for certain asset classes, where selling is probably not the right move right now. You have to just hang on to the property if you can. And if you can't, you have to prepare to give up a big discount. So option number 4 is changing over to a home equity line of credit mortgage or doing a reverse mortgage on your home. Now, these are two different products, but at the same time, they kind of work the same way. And it's the same type of people that usually look to do these. For these two products, you do need to have substantial equity in the home and you need to qualify for the mortgage amounts and interest rates based on your income and your total debt load. So let's start with the home equity line of credit. So let's make the assumption that you have a $330,000 mortgage left. It's come up for renewal. You have 10 years left on your mortgage and you're looking at 6.5% interest rate. The payment right now that you'd be looking at is $3,700. So if you get a home equity line of credit, you can drop this payment to an interest-only payment via a HELOC mortgage where the balance outstanding is going to be $330,000. You're going to pay no principal, but you're going to pay just over $2,000 per month. So effectively, you're not paying off any debt. You're kind of spinning your wheels. But again, the whole point of this video is to show you different ways you can weather the storm of these high rates where you lower your payments so you can sustain your life, so you don't have to sell your property. Now, your second option is doing a reverse mortgage. And again, this is highly controversial. I'm not recommending or saying that you should do it or you shouldn't do it, but at least I'll show you how it works and compare it to the home equity line of credit because it is a similar theme here. The one thing to keep in mind with reverse mortgages is that you do need to have substantial equity in the home, like way more than 50%. And the qualification criteria is based on income as well as your age. So using the exact same example as before, assume you have $330,000 on your mortgage right now. The home is worth about $1 million. You're 60 years old. If you did a reverse mortgage, you would get advanced effectively the $330,000 to pay off the existing mortgage, and then you would effectively be accruing $146,000 over the period of the reverse mortgage. So what does that look like in real life? So you have the $330,000 loan on the balance sheet or on your mortgage that you owe. And then what the reverse mortgage is doing is it's saying, okay, you no longer have to make payments. I'm just going to accrue interest and chew away at the equity of your home. So in the first year that you take on this product, you'll have the $330,000 that's outstanding, and then they'll add another $25,000 of accrued interest. So you don't pay any monthly payments. However, the lender is chipping away at the equity. So your loan after year one is going to be $330,000 plus $25,000 of interest, which is $355,000. So in the following year, they're going to calculate the interest based on the new outstanding loan amount. And basically it's compounded interest. So that effectively this is how you arrive to the $146,000 you would owe above and beyond $330,000. Now, reverse mortgages were okay when rates were low, meaning it didn't cost you that much to advance money and not have any payments. But right now, they're absolutely not worth it, in my opinion. I think they're chewing away at your equity way too fast. And I think anybody that's considering a reverse mortgage is probably a good candidate to consider selling, because this way I think you're going to end up in a position where you're going to be forced to sell by way of a lot of equity got chipped away via accrued interest, and the price of your home also came down. And after a certain loan to value amount that you reach, the lender will say, hey, I can no longer do this. You have to either pay off the entire loan by selling your house. And if you don't do it, I'm going to force you to sell it via power of sale. And as a quick note, I do want to say why I lumped reverse mortgages with HELOCs together is just to show you the difference in monthly cost to you as the borrower. So if you took on a HELOC of $330,000 at 7.5%, your annual interest works out to about $24,000 or about $2,000 per month that you're paying every single month. So this balance doesn't actually grow. If you do a reverse mortgage at 7.49, the monthly accrued interest is actually $2,400. So it's effectively 25% or 20% more than it is with a HELOC. The reason for that is because this is compounding. So if you remember, here you're making a monthly payment of $2,000, so that the amount stays the same. So the interest is only on the $330. In the reverse mortgage situation, you're making no payments. So the interest every month is accruing on top of the loan amount. So by the end of the first year, you have about $355,000 outstanding. And then this 7.5% is calculated based on that. So over a 5-year term, this is the difference in cost going with a reverse mortgage versus a HELOC, except obviously this one, there's no cash payment layout on your behalf. Now, the last option here is going to be private lending, and I'm not going to spend too much time on it, but before I get into it, if you like the video, if you think the content was great, please like and subscribe to the channel. This helps me a lot to know what kind of videos you want to see in the future. Now, back to private lending. So when it comes to principal residences, residential transactions for families, I don't think private lending is a tool that you should even consider. I'm conservative, so that's how I feel about it. That doesn't make it right or wrong. I think for investors, private lending will make more sense when they're just cash managing or they're trying to bridge financing between different projects or whatever the case may be. If, as a principal residence owner, not an investor, you find yourself in a position where you need a private lender, unless the situation is temporary, I think you're actually digging yourself a bigger hole. So I would probably suggest at this point, it is more than likely you would be better off in the end if you sold the home on your own terms rather than taking on more debt, taking on more broker fees to arrange for this type of debt, buying yourself more time, and then effectively not being able to manage that cash flow and being not foreclosed on, but being forced to sell, which is called the power of sale, where the lender doesn't, where you've missed a payment or you cannot repay the private lender money back and nobody's willing to give you the money. Then the lender is going to come and then they're going to force you to sell on their terms, however they see fit. You don't want to go to a situation like that. There's going to be legal implications and it's just extremely stressful. Yes, private lending is available if you're a qualified buyer or if you're a qualified individual, you can get something in the 9%, 9 to 10%. But remember, brokers will charge 2 to 3% broker fee and it's paid upfront when you get the loan. It's very costly. And these are usually 1-year interest only loans, which are repayable at the end. So you can buy yourself more time, but at the same time, you're not really improving the situation. And if the market continues being stagnant or flat, it will make your situation worse. So I think for people like that, it's better to get ahead of the situation and consider selling rather than putting themselves in further debt. And with that said, I hope you enjoyed this video. I hope you found this helpful. I'll see you in the next one.